Hello Sector Watchers, welcome to the show. This is the 130th episode of Sector Spotlight for Tuesday the 7th of June, and I'm recording it on Monday the 6th of June. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. You can find my contact details on the screen in case you want to share anything or have any questions you would like to ask. For today, last week we did a long show on monthly charts and on seasonality. So today we're going to go back to our usual sequence of looking at the current rotation for asset classes, then followed by rotations for sectors. And for this episode I want to squeeze in at the end a segment on real estate, because I think there's some interesting developments going on in real estate. So that's V and Q in the asset classes and XLRE in the sectors. Let's get started. Ladies and gentlemen, this is Sector Spotlight. Two relative rotation graphs for asset classes, the weekly version on the left and the daily version on the right. If we start with the daily version, then we see that it was a pretty good week for trend-wise for V and Q and SPY for the stock market, and pretty much all other asset classes, all other tails are traveling in a southwestern direction, which is negative in terms of trend. If we look at the performance, then it's interesting to see that both commodity ETFs, GSG and DJP, put in a nice week with 3.7 and 1.7 gains. These are also the highest ranking tails, the highest ranking securities, highest ranking ETFs in this universe. The government bonds, corporate bonds and high yield are moving in tandem. The high yields they showed a nice little hiccup through the week, but then on Thursday, Friday, they moved back. So they got back in line with LQD and GOVT, and then the US dollar is moving into the lagging quadrant. Now, if we put this into the bigger picture, which is on the left-hand side, here we have the RRG on a weekly scale, then we see that the commodity trails are still very, very strong. They're a very high reading on the JDK-RS ratio axis, but they're still losing relative momentum. Important with this kind of moves is that they're not losing too much on the RS ratio scale. So that helps me understand, that tells me that this is more a correctional move, like a temporary setback, because the relative strength itself remains intact. It's just the momentum of that relative strength that is going through a setback, and that's what you see here with these daily tails. Needless to say that the performance of both commodity asset classes in the bigger picture is still way out of line with the rest of the securities. So commodities is still where the performance is made. If we take these out, we got a little easier picture for the rest, and then you can see basically what we already said here is that this is a temporary move, and you see that corporate bonds, high yield and government bonds are continuing their strength, continuing their rotation at a strong RRG heading, while stocks, S&P 500, is continuing at a weak RRG heading. And you can also see that especially for GOVT, for these fixed income tails, that the distance, so RRG velocity, which is the distance between the observations, is jumping. So you can see that. Let me put this here. You see that all of a sudden the distance on these tails is much bigger, and so is it for SPY. So it's picking up that relative downtrend for SPY and relative uptrends for the fixed income stuff. And the same goes for V and Q. The US dollar is still at a high level, but rolling over, and you can see that here on the daily RRG, where it's already inside the lagging quadrant. Still, given the high reading of the US dollar on the weekly RRG, I'm going to treat this move as a temporary setback as well. Let's have a look at some of the individual charts. Start with the US dollar, then we can see that it's maybe not good to say the reason why it's setting back, but it's definitely helpful that you can see that the US dollar really tested a long-term overhead resistance level. So it's the peak that was set in December 2016. Then we had that real jump in March 2020, and we tested that area, peaked a little bit above it very recently, and now are dropping back. If we draw in the trend line here with the stippled lines, then you can see that that old resistance seems to be acting as support right now. If we translate that to the euro dollar chart, you can see that here that downtrend is still fully intact. We are getting back into that channel, so right now I'd say that the area around 108 is important for euro dollar. If we break above that, if we get there, then I think the upper boundary of that channel is what we could reach, which means like 109, a little bit over 109, 109.20. Look at the daily version of that chart, then a new trend line is popping up, and I've drawn that in here for you, and that connects the recent highs of this year basically. So that's February a few times, and here is still February, and then you got the peak here in March. Here we don't reach it, and now the most recent peak was the 30th of May, and it looks as if we're getting back into trouble again in this area. So this could be a very nice double, triple resistance area if you want. That whole area, let's say just below 108. I'm going to watch that very closely, because I think that that's a very important resistance level. If, and that's a big if we break back below this low here, that's 106, let's say 106, then we got a signal or a suggestion that the downtrend is continuing, and we may see an acceleration lower, because that 106 area was important. It was 106.4 here was a peak, and now that's tested as support. If we break that 106, 106.40 area, I think we could go very rapidly for a renewed test of 103 and maybe even lower. We go to SPY, then I mean lower highs, lower lows on the weekly chart. So for me, it's a downtrend. That's very clear. Question is, so it's a downtrend, and we are rallying within the downtrend. Question is, how far can this rally go? And if I look at this weekly chart, then I see that this is today, so 2 weeks ago we peaked at 415. Last week we peaked at 417, 417.44, and that is 419.50 was the low here, and this cluster here. So the whole area between, let's say, 417.5 and 420, it looks like that is a resistance area. Question is whether we will break higher or whether we will be putting in a new peak here, a new lower high, which would be confirming the current downtrend in stocks. If we look at the daily charts, a little bit more complex. You see a lot of volatility, a lot of spikes left and right, but it gives us a little bit more clarity that 417.5, 420 area is definitely visible. Sometimes you gotta not be very picky with your highs and lows, but I just draw them through the areas. I call them areas of support or resistance. That 419 stands out, and then you can see that we had a few periods where that area was tested, and does it again here, and now last week we had 417.44 as the peak. Today we opened up pretty well, and now we're already dropping back to 411 as I'm recording it, but market's still open on this Monday. Again, if we get a lower high in place, if this is the high for the week, and we move lower and we move back below 407, then it looks like we're going to have another acceleration lower. If the market can take out 417, 420, then there's a little bit more upside to 430. But I hope you agree with me when you look at this daily chart that it's all working its way higher within the longer term downtrend. There is, I don't see any signs for a reversal in stocks really soon. We go to government bonds. I think that's where the crucial information is coming from. If you look at Gov, that is testing potentially breaking, depends a little bit on where you draw your support line, previous lows. These are the lows of 2018. That's a pretty serious support level. If that breaks, then we will see even higher rates. Let me make this even longer, this chart, and you can see the impact of that. That's a very important level. It goes back to 2013, and if you see areas of support in this case, then you could conclude that it is already broken, and we've seen the pullback and we're now on our way down. If we zoom into the latter part, then I think the level to watch for GOVD is 2380 something. And if we go to the 10-year, that's slightly different because it shows you the same picture. We're on the way. We saw that big head and shoulders that we're still working our way lower from. We've reached that target, but as you know, if it's a target based on head and shoulder, it's the minimum target. We've reached the minimum target, but this is still a downtrend for 10-year bonds. Again, here, if we break 99.70 for 10-year bonds, that'll be a very crucial level. That'll send rates even higher than they already are, and we haven't seen those for a very long time. Again, here, and here you see that same area. This is, let's say 100 in IEF. That's really a level to watch. Now, if this holds, if we are not breaking it, then we could be in for a nice rally in the bond market. But in order to get that, we need to take out the high here, and then it will be completing a double bottom and potentially send bond prices higher, yields lower, but it's all within that longer term downtrend. So it all fits in that temporary setback where we have yields maybe go lower, stocks maybe go higher, or maybe we've already played out that move. But the big picture here for in asset class, at asset class level, I believe is that stocks are in a downtrend, government bonds are in a downtrend, 10-year bonds are in a downtrend, yields are in an uptrend. There's obviously the reverse. That's not a very good combination. And what we see now, the rally that we are currently seeing, and it came off that, forgot to tell you about that positive divergence in the RSI. That's where we're working our way higher off that. That needs to be digested by the market. Depends a little bit on where it ends, but I believe that we're still in that downtrend. What we're seeing is a rally within that downtrend, and the price action in the bond market will very likely be crucial to what we will be seeing in the months ahead. If we look at commodities, you see that DJP is trying to break out from this little consolidation that it had over the last few weeks. And if we make that chart really long, that is very interesting, because what you see then is that it is a former peak, goes back to 2014. If we take that out, it's not strange that we had that hesitation around that level. If we take out that high, then DJP could be in for a move towards 45.20. And you'll see quite similar picture for GSG, where we are now running against resistance coming from old lows going back to 2009, 2010. And if we zoom in on this one, you will see that we're looking at the same image. So getting away from that consolidation. So it looks like commodities are lining up for a new move higher. And then quickly go to V&Q. We'll deal with that a little bit more when we talk about XLRE in the sector segment. I think that real estate has put in a very important peak, and we're facing lower prices for real estate. That could fit in with higher rates. So we'll have a look at that when we talk about sectors. The current sector rotation pretty much fits in with what we discussed when we talked about asset allocation and asset class rotation. Defense still leads. Offense, cyclical, goes the opposite way. And I think that's best visualized in the weekly RRG, which we have on the left here. You got technology, discretionary, two of the most offensive sectors inside the lagging quadrant. Financials is offensive, moves higher like XLKey, but they're inside the lagging quadrant. It means that the relative downtrend versus the S&P 500 is still intact. And XLP, XLV, and XLU, those three are widely seen as the most defensive sectors. They're all inside the leading quadrant. Now, you can see that the tails for the defensive sectors are rolling over or moving downward, where the tails for the offensive sectors are moving upward, except for discretionary. That fits in with the temporary counter-trend move. So the big picture is for defense to lead, cyclical to lag, but right now it's the other way around. Big question is how long it will last, and we really don't know. We just have to monitor the market to find that out. Energy obviously still way to the right as the leading sector. Now, what happened last week? If we look at the rotation in the various sectors last week, then we see a very strong move for consumer discretionary. But as you can see, the only effect that that move on the daily RRG had on the weekly tail is that the observation, so the velocity slowed down. So the week-to-week observations got a little bit smaller. Not very impressive. If you look at the move for technology, so where is technology in this image? You see it's here in blue. You see that it's moving slowly towards the leading quadrants, pushing this one up a little bit, but not much. Look at how close all these observations are together. Compare that with the move down for XLRE, for example. So that's a very slow move. We can go through all those. So financials rolling over, starting to move lower. That fits in with financials inside the lagging quadrant. You got discretionary moving higher. That's a pretty big move in terms of relative momentum on the daily, but it doesn't have a lot of impact on the weekly tail. So that makes me believe that we are looking, or we should be looking, for a tail on XLY that is rolling over, insight improving, or maybe you can hit leading, but in the end of the day, it'll be rolling over and starting to move down to get back in line with the tail on the weekly RRG. XLRE, we get back to that in a minute because I think that's where the interesting stuff is at the moment. Technology moves a little bit higher, very short tail, so low RRG velocity. That fits in with the move here inside the lagging quadrant. Energy loses a little bit of relative strength, but it's very strong on the weekly. So here, just like the XLY tail leads me to believe that it is a temporary move and it will eventually fit in with the weekly, I do think the same for the energy sector, that this is a temporary move and eventually we'll get back in line with the rotation on the weekly RRG, which is very strong. Utilities setting back here, that is pushing that tail on the weekly here down, but that is also, it's the second strongest on the weekly RRG in terms of RS ratio. That doesn't change overnight, so this I think is also a temporary move, and the same goes for healthcare, which is right here. When you look at that this is healthcare, so you can see that they're now in line. So these defensive sectors are losing and the offensives are picking up. They're leading to a degree, but the bigger picture, defense leads, offense lags. We got materials, staples, rotating already back up inside the lagging quadrant, where it's just rolling over here inside leading, so we'll have to wait and see how quickly this can catch up. Industrials, very short tail, getting back to the center of the charts, more or less in line with the benchmark. And communication services is now again rotating back. That's a bit of a pity because it was resting at support. We'll have a look at the chart in a minute, but you can see that now the weekly is already starting to roll over, and it looks like communication services has had its run and is now again in for another move lower. Let me bring you some of the individual charts. Here is materials. They're inside their rising channel. It's not at a very fast pace or a steep angle, but it's rising and it's moving higher. Makes it a very good sector from a relative point of view. If you look at communication services, as I said, we hit support. I've mentioned it a few times in the past. We could still be looking at a low in the making, but the current relative rotation suggests that we will need to see a little bit more downside. So a little bit of a fantasy outlook here. We had a rally, we might be going down. So when communication services hits the 56.5 area again, that could be the interesting part to watch for buying opportunities inside communication services. Way too early to do that right now, but keep it in the back of your minds. Energy, as I said, still doing very, very well. Relative strength, no problem. Here is financials. You can see the topping pattern that broke initial rally, and we're now bouncing back and we're already running into trouble again. So this remains a very weak sector, and it is holding up in terms of relative strength above support. That's why we're pushing higher on the tail inside the lagging quadrant. But I'm not sure that this will hold up, especially not when we are going to put in a lower high here and this is going to come down again. Here is industrials, again slightly longer term topping pattern rather than the financials that we just saw, but it is a topping pattern nevertheless. We're now testing the old support as resistance, pushing against resistance in the relative strength. Not much upside there, I think. Here we've got technology that's pretty much in line with what we see in the S&P 500. Lower highs, lower lows, and we're now pushing against resistance. Same goes for relative strength. Here is consumer staples. That's kind of worrisome because we broke out of that channel and we're not going to come back into that channel. So a very defensive sector is now breaking its uptrend while it's still leading in terms of relative strength. So that's not a very good combination. So I'm going to watch this closely. Thinking support somewhere in the 70-72 area. And here is utilities. This is still doing what it's supposed to do. It's still in its uptrend. Support, old resistance tested as support, and we're now moving higher in terms of relative strength as well. And here is healthcare, starting to be in a range, but relative strength still broke out, so that's good. And we're losing relative momentum, but we're still above that breakout level. So I'm going to watch for a new low in relative strength to be put into place here and a move for XLV back to the upper boundary of the range on the price chart. Now you missed one sector, and that is XLRE, that's real estate. And we're going to take a look at that in the next segment. The real estate sector caught my eye this week when I started looking at my charts. First on the asset class rotation and then again on the sector rotation chart. Let's bring it back to the RRGs. If we look at the tails for XLRE on the weekly RRG, which is here on the left, and the daily RRG, which is here on the right, then you can see an obvious weak rotation, especially on the weekly. You can see that after a very nice stint, we had a very sharp hook back about 5 weeks ago. And meanwhile, it has reached the weakening quadrant. This is 6 weeks. So the 30-day period here is roughly the same period as you see on the weekly RRG. And you can see that the initial rotation into lagging, and then we had about a week and a half, maybe 2 of improvement, which would be somewhere here where you see, I'm not sure whether that's very good to see on the screen, but where the segments were getting a little bit smaller. That would be the period where the daily tail is moving higher. And now you can see that it is getting bigger again, and we're getting an acceleration, and that is coming from the tail on the daily that is rolling over, rolling over inside improving, starting to pick up downward momentum. If you look at the price chart for real estate, then I think there is an interesting pattern to see. And I mean, I've annotated it, but to me, this looks as a pretty nice head and shoulders pattern that was completed a couple of weeks ago. And we had a pullback 2 weeks ago to the neckline, which started to serve as resistance. And we're running into trouble again. And while I was working with this chart, I was looking at it, and you see that there is, you can see a cluster of support here and a cluster of support there, but it peaks a little bit lower. You got the same here. You got this little, if it were a candle, you could call it a wick lower, and then we're pushing higher. So when I see these type of charts, I always I want to peel off all the unnecessary information and look at this chart in its purest form. And I think that is a line chart. So when I make this a line chart, watch this. So we're going to change open, high, low, close, and we're going to make that a solid line chart. And then update that image. And when I see this, I think like, whoa. So we've got this lines up 1, 2, 3 lows, and now the pullback closes. This is weekly closes at pretty much exactly that neckline level. I think that is an important sign. If you look at the formation here, we're looking at 44 to about 50.52. That's about $8 downside potential, and that brings us into the range of 37, so 36 to 38. This box here is the price target for the real estate sector. Add to that the possibility of the outlook for further rising rates, or at least a weaker bond market. Real estate doesn't like that. And that concludes Sector Spotlight for this week. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. I'm looking forward to see you again next week, same time, same place.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.